All right, we are now officially recording. So good, bad, or indifferent, folks. We're in this for real. So I'm going to share my screen, and I'll give you a couple quick minutes about what's going on the OPEB side of things, the healthcare side of things, and then I'll hand it over to Brian and Margie and let them do what they need to do. Again, they are really probably the more important features here because they're going to have all the information you really care about and why you came. But I'm an actuary. I'll tell you a little bit. I know most of you are already existing Odyssey clients, and if you're not, welcome. If you've heard me speak before, hopefully you'll see that I try and do this as close to I can as layman's English so that we're not trying to show off actuarial expertise, but rather get you information you can actually use. So with all the COVID stuff going on in the world, as you guys are quite aware, you'd think, oh my God, healthcare costs are going through the roof. Actually, quite the opposite. Healthcare costs have dropped dramatically. Year over year, emergency room visits down 42% in April. Personal consumption healthcare spending down 40%. Anthem, one of the largest providers, is offering 10 to 15% rebates on a lot of their fully insured products in July. It's just no one's spending any money. Now, eventually that's going to come back. It's not like we solved the healthcare puzzle and costs just dropped by 30 or 40%. But in the short run, nobody's going to doctors right now. As you can see, in a normal year in hospital costs, surgical is about 37%, emergency room is about 25%, maternity is about 20% of your hospital costs. What you're going to see is this graph goes along nice, la-di-da-di-da, and then all of a sudden plummets. And as you can see, dental services down 61% year over year, physician 45%, hospitals down 40%, healthcare, home healthcare down 33%. Even on the private insurer side, they're telling you that, hey, overall, we're down 30%. You know, physician services down 35%. So that's the healthcare side of things. And that's really the important stuff because that's what drives everything. I mean, listen, I know Margie and Brian are going to talk about the OPEB trust, and I'll tell you all about interest rates. But ultimately, the cost of the plan is the benefits you pay out the door. So that's really what we want to focus on. But with that said, the municipal bond index rate, which drives, for those of you who are not funding, that's really what drives your liability. Last year, that was 2.79% for a yield to maturity. It was 263 at the end of May, and as of last night, it was 266. So it's, with all the ups and downs and going back in March, you know, those numbers moved dramatically. We've come back to basically where we were. The long-term rate of return under GASB 75 is based on a building block approach. You'll hear me say this often, and Brian will talk about it as well. It's all about how you choose to invest the money. If you're going to be all in cash, you're going to get a very different long-term rate of return expected than if you're all in equities or there's somewhere in between. So we base it all on your portfolio by asset class, what percentage each class. We get a real rate of return, in other words, net of inflation, build that all out, and then we add an inflation rate to that to come up with a long-term rate of return. So then we have to blend that to a single equivalent rate of return. As many of you have done GASB valuations, many of you, as you'll see in a minute, you will find as of the end of 2018, we're about 4.25 for the average discount rate. Well, the median discount rate, let me say that. The 75th percentile went from 5.56 up to 6%. So more people are funding. As more people fund and more people fund more aggressively, you get to use a higher discount rate. The key thing here is, and this is, you know, Brian will talk about what's happened in the market. If you had a good year or a bad year in the market this year, that has no impact on your long-term rate of return that actuaries like myself are going to assume. We base it on the long-term forecast of the asset classes, not the year-to-year of what happens. We've done a survey of some clients recently. About 60% of our clients thought they would reduce OPEB funding in the coming year just because we're going to have a very unusual budget situation this coming year. A lot of that depends on what Congress and the state does, but at this point we don't know. But if you were to reduce funding, and I'm not recommending that, but if you were to do it, the question is really, is this a one-off or is it a, hey, we're just going to cut funding altogether? And if it is a one-off, let's just say you cut funding by $100,000 to make the math easy. Is there a commitment to try and make it back up? In other words, are you going to say, hey, listen, I'll cut 100,000 out of 2021 and do 25,000 extra in 2023 through 2026, let's say. If you do something like that, the auditors and the rating agencies community are unlikely to view that negatively, at least not in the audit community we've spoken with. The other big thing is, and a lot of you heard me talk about this before, post-pension funding. At some point in time, probably later now than what you might have expected, your pension system will be fully funded. the point here is you can redeploy some of that savings, if you will, in 2036, 2038, whenever, and have those be committed to OPEB. Now, the key thing here is when I say committed, it's committed as of now until a future board may change. But the point of this is if your board decides to commit those funds to OPEB, we're allowed to use those in our discount rate calculation. And therefore, instead of maybe using a 5% discount rate, we might be able to use 6, which would therefore drop the liabilities on your OPEB by maybe 15%. So there's a lot of real benefits to doing that. And the other key benefit is, let's face it, if you don't put a claim on those funds now, somebody else will. So it's better to get a claim on those funds while you can before other people think of it. Again, you'll see some OPEB funding, as of the end of 12/31 last year. Listen, everyone still has a long way to go. 33% of our plans were less than 1% funded. Even 85% were less than 20% funded. I know we have a couple here in the room today that are pushing 100% funded. You are the anomaly. You are not the norm. And good for you. And Brian will talk to you, I'm sure, about the differences in asset allocation between those who are 5% funded and those who are 95% funded. You guys have a very different mindset or thing you need to do. On the pension appropriation side, I guess I would tell you this. Those costs have been going up. They're going to go up more. That ignores what just happened in the market. But the reality is PARAC is asking everybody to take their discount rate down to 7%. As they do that, costs go up. People are living longer, costs go up. And then Wilshire found that in the first quarter, pension funds went down by 13.2% on average. Now, hopefully they've come back a fair amount in the second quarter, but nonetheless, that's going to cause a budgetary strain. So just keep that in mind. And then I'll leave you this from our great American philosopher, Yogi Berra. And this is more for Brian stuff. Again, it's tough to make predictions, especially about the future. So with that said, that's really wraps up my part. My card is there, and obviously most of you guys know who we are. But with that said, the big thing here is I'll introduce you to Brian and Margie. So Margie Vose and Brian Callow, both of Rockland Trust. Margie is a senior consultant there. I don't have her exact title in front of me. I think it's vice president, but I apologize. Mm-hmm. And Brian is their fixed income portfolio manager. So these guys have been doing this stuff for a long time. Many of you have worked with them many, many times. They are the people that make all this stuff go. So the key thing, and Brian will talk about this, and you guys have all heard me speak about this before, you can't fund your way out of this problem. There's not enough dollars. You need to do it with both the plan design side and the funding side. But beyond just the funding side, there's not enough contributions. You're going to need asset returns to help get you over the hump. And that's why Brian and people like him and his team would help you get over that. So I'll turn it over to him and let him talk to you about kind of how they do things, what's happened in the market, and and what the whole process looks like.
Great, thank you, Parker.
Thank you.
I'll just start off first, and then I'll turn it over to Brian. And just to point out, we have Rebecca Tavares pictured here too. Just wanted to let you know who that is here. She represents our government banking team. So I'm with the investment management group, where we have extensive resources and expertise of a large institution matched with deep personal service of a community bank. $4.5 billion in assets, over 80 professionals, 35 designations. So of those 80 people, 9 are a charter financial analyst, which is the designation you want when someone's managing your money. We're the 18th largest independent investment advisor, high client side satisfaction ratings, and 9 investment offices. So we have dedicated a whole team to the municipal channel here at Rockland, and expertise in mass general law. So here you have myself. I joined back in 2015, so 5 years ago. I was hired to dedicate 100% to the municipal channels, mostly in Massachusetts. And as you all know, there are many nuances in mass general law, so we really need to focus on the needs of this channel. To the right is Barbara Howard, relationship manager. She's been with the bank over 40 years. She oversees account administration, including record keeping and reporting, and very astute in mass general law, and keeps up with all the many changes with the Modernization Act and how that impacts your existing accounts with us. And then speaking today is your portfolio manager, director of fixed income, CFA. He we'll integrate the investment strategies that you've set aside with your IPS according to prudent investor rule and or mass legalist, whatever pertains to that portfolio. And as director of fixed income, he also analyzes municipal debt on the other side. So as you know, there's been a lot of activity in the municipal markets as of late. And then our government banking team we partner with. This is headed up by Debbie Hayes, and pictured here is Rebecca. So we partner together. They represent the depository side of the bank, and we call on the same people. So it works really well together. We service over 280 municipalities and about 1.3 billion in assets. Okay, so why Rockland Trust? We're local. We have expertise in the municipal market. We have a credentialed team focusing again, mass legalist and OPEB trust funds. We have a disciplined investment process, and this has been critical, particularly in this past few volatile months. So we participate on the upside, but protect on the downside. And what we've been hearing in our client reviews the past couple of months is people have been relieved when they open their statements, and it's not as dire as all the headlines that they've been reading. Dedicated reports, we help match your needs with customization, whatever systems you're using, Munis, Excel, whatever works. We collaborate with auditors, actuaries, and accountants. And as Brian will go into later, he can customize portfolios to meet your individual need, whether we're talking stabilization, trust funds, or long-term OPEB funds. So it's critical that somebody like Parker understands how you are invested. It's not a one-size-fits-all. So if you are invested more aggressively, that will impact your discount rate favorably. Investment counseling. So Brian Callow is direct access to you. There's not a 1-800 number. You can call him, email him. He and his team are very responsive all the time. In fact, during this quarantine, we've been in touch with most of our clients, either phone call or individual Zoom client portfolio reviews. We've done Zoom calls by county to brought in some experts just to address any needs and just to kind of stay in front of everyone. So it's very important. So this next page, I'll just go through this wheel here. So there are many facets of creating a successful OPEB trust, as you know, and we will help you every step of the way. So let's start down here at 7 o'clock on IPS. Very important document. It's a good starting point for any portfolio, really. So it's important not to make changes to this, particularly during pandemics or whatever crisis is happening. So say it's January 2020, and you have an OPEB trust portfolio, and you're conservative or maybe a balanced approach, and you're frustrated watching the S&P break all these records for a long time, and your portfolio is not keeping pace. You move into equities. You say, I'm going to take advantage of this market. You watch it ride down to February 19th, and you're even more frustrated now because of your losses. So you say, I can't take it anymore, moving into cash. And then you watch the market ride up to March 23rd. Okay, so it's really important to have your hands on the wheel with your IPS. Do you have a written funding plan? A sustainable written funding plan. Parker loves these, right? That will really help your discount rate if you stick to a written funding plan. We've also heard from auditors and rating agencies that in light of this pandemic, if you miss a payment or if you have a hiccup in your plan, you know, if it's a one-time situation, you have a plan to resume, you will not be penalized with that change. Risk tolerance. It's really important to understand what your risk tolerance is and volatility. You as a treasurer or finance director may have be a little more astute with the financial markets. You invest $1 million portfolio. When it's time to get that next funding, it's down to 900,000. Will the townspeople or whoever the committee is to vote on the next funding be affected by that? So that's important to share. Time horizon. OPEB is long-term funds for most municipalities, and you should take advantage of the equity markets to help meet that goal. However, we have taken on clients who are close to fully funded. You know, as Parker said, they're few and far between, but they shouldn't be invested in that risky asset allocation if they already have their funding. And then last but not least, your governmental structure. Politics play into everything, as you know, and it's not always rational, and it's usually very emotional, particularly now in terms of teacher furloughs and Congress preparing different relief packages that may or may not help you. Is it strictly COVID-19? Is it for your budget? We can help you with that, and we can support you in your selectmen meetings or town meetings or whatever format you need. And then, it's hard not to mention COVID-19, but we've heard from some municipalities that do have to tap in their stabilization funds that was not planned, whether it's rainy day or stabilization funds. And will that impact your OPEB funding? So it all comes together into one wheel, and we can really help you with all of that. So to wrap up, I will just introduce Brian Callow, who is, I said, Director of Fixed Income, Senior Vice President here at Rockland Trust. Been here 17 years. Undergrad from Florida State and got his MBA at Babson College. He's a CFA and a member of the Boston Society of Security Analysts. With that, I'll turn it over to you, Brian.
Great, thank you, Margie. And hello, everyone. If I have it correct, I might be off. No, I think I'm on, but I think many of us, if not the majority of the crowd, would be driving home from Hyannis right now. So a much different week than I expected when I looked at my calendar in the middle of the winter. And so I like many of you, I circle it and looked forward with high regard to seeing everyone and socializing. So I am so sorry we're not getting to do that. As I said, I look forward to it, and I think others do as well. So I'm sorry I didn't get to see everyone. I guess this is a replacement for it, and we're glad to have any kind of interaction we can with people. So, so at least it's good to be reaching out, but it's a very, obviously that's the extent of how different this year is just from, and that's just kind of a business sense, never mind all the other items that have been happening here. So on behalf of Rockland Trust and myself, I hope everyone's families and extended circles have been healthy through all this and safe. So that's first and foremost that you need your health and you want those around you to be. So that's number one. And then from there we have all the employment, et cetera, issues in the economy and travel woes, et cetera. So that's kind of starting from the ground. So we wish you all well. We want to thank Parker and Odyssey for putting together this forum for us to be able to communicate with you. And so thank you for that. And Margie, thank you for the introduction. I will say Parker and he was saying he was going to do an introduction, but or just a general intro and set the stage. But I think that so much of all his words were so important because we come out and then on my side, I'm always thinking on the investment side. And as we say, we talk to rating agencies. We try to get going into every nook and cranny we can. So we're only half the picture. The other half is really the cost structure and what can be controlled and what can't on that side. So I always love it when I get together with a larger group or a panel like this, and we get to hear the other side because it's certainly important. And I'm with that same group that would have said, "Oh my goodness, what about healthcare costs?" And in the same item right now, I think I got about 4 different things, doctors that are lined up to try to work on me or want to, that have been pushed off for the summer. So I'm right in line with that group. But so thank you very much, Parker. We certainly appreciate it, and to the group for taking your time on such a beautiful day. As I dive into these slides, a few of them we've done a multitude of different Zoom meetings and so I've recycled some slides. So if anyone's seen them before, I will apologize in advance, but they're all pretty much poignant in general, or I should say pretty topical. So this first one Margie has up right here is the stock market. So it's been shown many different times to many different ways, I guess. But it's pretty interesting. And it's funny, I go into these town halls and city halls all the time, and usually treasurers look at me the last several years and Brian, we just don't have enough volatility out there. We need some action. Obviously I jest because no one really wants the market jumping around like this, but certainly volatility has come back. And if we look at this chart, and I'm going to start going really from year to date, you can see the market increasing and really topping out in February 19th was the day. If you look at that day, COVID had already been really running roughshod over China for, they said it started there on December 3rd. We don't know for sure exactly when they were feeling the effects, but certainly through January and February. And I'll admit I was in the camp that didn't think it was going to hit with the levity that it did in this country. So I guess we know. And I was certainly, and as I say that, we certainly weren't alone, given that the stock market's peak was really a week from it hitting. And that next Monday, the market started declining. And I remember, because I was fighting the flu, to now I don't even know whether I had the regular flu or COVID at the time, but I was pretty down and out. And I was taking calls each day, and everyone said, I'm really worried about Sanders winning the Nevada caucus. What's that going to do? The market's down today. What's that going to continue to do? And I said, well, some of it's Bernie, and the other portion is the fact that Japan over the weekend loaded up on U.S. debt and made interest rates decline, and it really kind of shook our equity markets. And then there's this kind of sickness going on in China. And it was almost an afterthought in the beginning of that week. By just the end of the week, it took over the markets. You can see by the end of February, we were down about 8% in the markets. In general, consternation and concern came into play. When it gets there, and as we've seen several times, the market likes to get to that 10% marker. So it can say, well, we've essentially got a official correction. The market corrects, and we've seen many times during this run-ups really since 2009 of it going down 8, jumping to 10, and then coming right back because the economy was so strong on the bottom. So we saw that. And then it started continually rolling over when we started shutting down. It went from 10 to 20 pretty quickly. And then the government said, okay, we're going to step in here. And the Fed said, we're going to try to help out as well. They took interest rates to 0. But before they could declare what their next moves were, because they didn't know them, they had never drawn up a PPP program or CARES Act before. And how do you design them and how do you get them out that fast? Just waiting those days for the approval after they had already said that they were going to be in, the market dropped another 10% to 30, down over 30%. This is where the panic ensued. And so for those people, for those investors that were ready to move, there were opportunities there. What we needed as a group was there just to be a pause. And if everyone paused and said, let's see what the government's going to do before we just do the old, what we did from 2008, which was fire in a theater, I think a lot of people would have saved money. And they would have saved their capital, because what happened was there was a lot of panic. There was a lot of people running to cash at that time, and not just general investors, but there was a lot of institutions, et cetera, making what I would say were fully subscribed moves because they didn't have all the facts. Well, no one had the facts. That was the problem. But there's what you learn, say it from a guy, and I guess I throw my age out here, a guy that's been in the market about 30 years, is there's a whole new breed of trader that really hasn't been in the market that long, and it's sitting on the front of these desks. And then there's a line of computers that are just lined up to trade at a certain point. So the computers started just unloading. Nervous traders started going to market. They haven't seen markets like that. They haven't experienced, and they don't realize where the opportunity are and the dislocations happen. So I would like to say that we, in general, we stayed pretty calm and collected. And we decided to make more, and I'll talk about it a little bit more in a minute, to make opportunity of it. And but it was important because you can see the whole decline down. It went down a great deal when you go down over 30% in essentially a month and in a couple of days. It's pretty dramatic. And then the market started coming back, and we can see how far it has come back overall from year to date. And as we sit here right now, I can tell you that the stock market is down 2% from year to date. So given all this, I'm going to talk a little bit about more of that. Essentially, overall, I'm speaking about the markets now. I'm also going to address what transpired with those swings, kind of some of the reasons for the market recovery, and then we'll hit on what you guys should do as kind of plan holders or administrators of OPEB funds. You can even speak about a little bit about other funds as well, because though we talk about OPEB as an investment manager, and Paco sees the same thing, we're looking at the strength of a municipality overall. So what you have in stabilization directly ties into oftentimes OPEB, because if you don't have your reserve fund set up, how can you be contributing into your OPEB? So we're concerned about all your buckets of funds, not necessarily your OPEB, just because we're speaking So here's the stock market over that time frame. If Margie goes to the next page, you can see what transpired to interest rates.
It's not going. Hold on. There we go.
There we go. So I cleaned it up and put just two curves in here, and I will apologize right there. On that last page, if you saw the big bright 8% on it, that's fiscal year to date. So I changed the curves from instead of a calendar year to date or a 1 year. These were both for fiscal year to date. So you're up 8% on fiscal year to date. So as I'm talking about the calamity in the marketplace, and I'm going to talk a little bit more about the recovery too, I do want you to see that the stock market overall, I don't think everyone's going to be, certainly your mass legalist and your stabilization funds are going to be in pretty good stead on the fiscal. I'm going to knock on some wood here and everything else because I'm speaking on the 17th and we're not to the 30th yet. But to this point, fiscal year to date, your portfolios are in probably a lot better stead than you would have thought given where we are in here. So to the yield curve, and you can see the yield curve at beginning of fiscal year to date is at that top line, or let's call that kind of yellow, and the bottom's the green. So a year ago at this time, or essentially a fiscal year to date, we were worried about the inversion of the yield curve. And we were debating on whether that was going to be a harbinger of a recession to come in 18 months from there. We were in one, but it certainly didn't happen the way we thought it was, which was going to be either the Fed moving the curve or was going to be the economy fizzling out. This is certainly much more dramatic. As a matter of fact, I would say the economy hasn't fizzled out. It was pretty strong going into that. So you can see the two things in it. One, you can see we're fighting inversion. Actually, I'm going to see three things. Inversion. Two, it was much higher. And then three, for municipalities that I don't want to say survive, but is a meaningful amount of your income that comes from interest income from all the funds that you have throughout. That has certainly changed. So if we just follow that short end of the curve, where it was essentially about 240 a lot of the time around a year ago, and then it drops down to essentially 15 basis points where we are in the curve right now. That's hard to get income. And you have to replace that income at a time where so many other revenues are falling. So it just puts one more strain on municipalities in general. So we certainly feel for you in that regard. And people sometimes overlook that on top of all the other issues you have, your investment income is going down as well. That the town gets, not the OPEB returns, meaning the interest income. So the Fed essentially here took the rates to zero. And since then, it's certainly done anything it can to make sure that borrowing rates are low enough for everyone to step into the marketplace. So if I go to the next page, here's kind of where you start seeing some shakeup or movement in the markets. So January 1 to February 19th, that's when we said the market kind of peaked up, where I can see technology. It's interesting to see technology and utilities being the two sectors ruling the roost there because they're very different. Over that time frame. The S&P in the middle, we were up 5%, and then you can see kind of the funding of it all, financials, but also really the negative ones are just the commodity-based entities. We go into the fall, the free fall, if you will, and at the top are all the things you would expect to when we talk about defensive sectors, meaning where we run when things go bad. Well, what was open when the economy closed? CVS and grocery stores. So there's your staples in your healthcare, right? So that's why those fell the least. And then the worst absolute time when that you can get into a energy price war is when there's a pandemic and no one is driving a ship, a plane, or a train, or a car, right? So that's exactly what Russia and Saudi Arabia decided to do, and started fighting over the pricing of oil and how much they would essentially output or they were going to provide. So that sent energy companies just spiraling down. So you had energy spiraling in the backdrop, which makes up a whole lot of the high yield market, or when they could talk about junk bonds. So you had pressure on that. Then you had the economy slow down. You had essentially no revenue coming in, or very limited revenue coming in across the board. So at this time, and this is when I showed that stock market before, this is when we went from 20% to 30%. Government said they're going to come in. How are they going to do that? So real quickly, the Fed came in, so we're going to buy treasuries, then we're going to buy agencies, we're going to buy corporate bonds. We'll buy ETFs in the high yield space. We'll buy municipals. And first they got in, and then they said they're going to fire off the Fed bazooka, if you will. And at that point, they said they will save all things. They were keeping the markets open, is what we're going to do for capital, essentially, so companies could access capital. Because what happened right before that was the market stopped, and that's when I was talking about people needed to breathe or essentially just pause. When the government said they were going to move forward, everyone said, okay, well, I'm sure you are, but we don't believe you to the extent that you said you're going to. And the cash markets essentially froze. And when the cash markets freeze, it's exactly that. All other markets that are going a lot further out or longer term freeze as well. And so people will come into market. And so you had the stocks immediately decline and their fundamentals decline. They should have, because their earnings were falling. You had securities, their credit being shaken because we didn't know if they're going to be able to pay, because we didn't know if they could access markets to offset the lack of revenue. And then you had just liquidity in nature. Okay, how can companies meet their immediate cash needs? What happened then is people said, we're going to sell the most liquid things we have. And so they started selling securities into the marketplace. And so what we did, and so when we're down 30%, Rockland Trust as an entity said, okay, what we're going to do across the board is make sure we have control of this. We're not going to do panic. We're not going to go to try to sell the cash. And at the same time, we're not going to do anything overly risky for our clients, because they know that we're not that kind of shop. So we immediately did what we've kind of dubbed, or whatever, investment triage. We said, let's look at everything in every portfolio we have. If it's, obviously right down to general funds. Okay, you have treasuries, et cetera, and those securities, you're good. If you have trust funds or stabilization funds, let's go through everything in the mass legal list. Make sure it's going to be able to pay its paying entity on the other side of this. OPEB, same thing. From all securities, let's make sure that they're going to be an ongoing entity on the other side. All hands on deck doing it. We went through every security. After we did this, we think we have what we want to generally hold as far as sustainability. Now let's make sure, with the market down, let's make sure we rebalance into the things we need. So if stocks are, they're a lot less of the portfolio now. We believe through time, if you think of this economy, and we're about 28-0 against recessions and downturns as a capitalist society, we think it was coming back again. So we said, okay, rebalance to the equities and make sure we have enough, not go overly aggressive, but let's buy back to the weights we have in your investment policies. And then also, let's look at all the holdings we have and see if there's better buys or companies that may come out faster out of this than the ones we have. And we did that as well, and that made some trades happen. The fourth thing we did is we said, all right, instead of blinking or being worried right now, let's look at these dislocations in the market because of the cash crunch. If you look at your portfolios, as municipalities, you don't have a tax advantage, but you probably might see some municipalities in your portfolio right now. The world was selling those, and they would have to sell them at a tune of, potentially 2.5% when treasuries were at 0.2. Well, we said, we'll take that swap because it's essentially mass or high grade paper. It's not going to have a liquidity situation in just a matter of weeks once they fix this. So we were buyers during that time frame. I would have bought it all day long as director of fixed income. Believe me, we were one of the first people into this market and noticed this dislocation. And we were one of the first buyers. So we were getting some of the highest rates out there. The problem we had was we were rebalancing our portfolio. So if anything, a lot of places we were selling bonds to buy stocks. So in this case, we sold treasury security to buy these municipals. So we were doing everything across the board to make sure our portfolios were stronger and had a better opportunity to perform on the other side. So this was a real important time when you look at this slide right here of how far it was down, because after that, all those moves we made during that month, we were able to take advantage. And so that certainly helped the portfolios across and helped your plans across the board. So that's why that's an important slide. So if we move from that to the next one, that's really essentially what we kind of dove into action. Now, you see the market come up this much, and I won't get too much into all the math, but essentially you say, okay, the stock market's up this much, and we can't even meet. We didn't go down there in June. We can't go out for lunch right now. You can't take, we're just being able to do that, mostly outside. but for a long time we couldn't. It's still a multitude of things we cannot do to spend our funds. So how can the stock market be back? You look at the left side of this chart up here, the S&P earnings. You can see the ones that we actually experienced, and then in blue, that's essentially the now expected earnings for the S&P 500. You see that huge drop-off that we're in right now. Market's saying yes, and I'm very happy that market participants are doing this, because too often they'll muddle in the present and say, well, we're down right now with earnings, so market should be. Instead, it's saying, let's look at our future earnings, what that means to stocks and portfolios, and what that means to me. And investors as a group have said, all right, it is down, and we'll kind of omit almost the earnings, or accept, I should say, the decline in earnings in 2000, as long as everyone then gets back to work and starts, one, producing, but also buying all the things we were expecting. And then you can see the expected earnings in essentially 21 and 22, those higher blue bars. So if we get that, and we get people back moving as we, similarly to how we did, and obviously we can do that with changes, that's what we're expecting, but if we start moving goods and services like we used to, then the stock market isn't as overvalued as it would first seem now, because from the fundamentals, when you look at its price to earnings, where the stock market is now versus what its expected earnings are, it's overvalued. When you look at its earnings in general, you say, okay, stocks aren't cheap right now by any means. But when you start saying, okay, when we look forward to what we think is a normalized economy, does it make sense? And that's what investors are saying. So that's why the stocks are moving as they are right now. Next to that is kind of the earnings growth. And you can see when I talked about those sectors from the last page, how they've been impacted. So on that far right, you can see the sectors most impacted. That's energy, as I just mentioned, which has been making a comeback, but certainly has a long way to go. Consumer discretion, because that's the thing we haven't been able to do, right, is act in a discretionary basis and spend the funds how we want to. So that's the next biggest sector really impacted, and industrials, because we're just not moving goods and equipment. Building structures as fast. There's just been too much interruption. So we look for those to come back. So that's kind of how the stock market is kind of looking at it, and we look forward to it. So if you go to the next page, here's the other side of it. Okay, if we get opened up and we start moving, can we pay for it all? Look at the unemployment. That's the brown bar in all of this. And so you can see the other times we ran into a large problem, which is 82, 92, when I was, I think I was still trying to look for my first job. I got my first investment job in, I thought I said January, I apologize, January of 92. And then again, October 09, and those were difficult times. And you can see where the unemployment rate is. Now you look at the unemployment rate and you say, oh my goodness, it's that high. And depending on how you factor in furloughed workers and the definition of them, who comes back and who doesn't, it could be plus or minus another 5% from there. So it's certainly, it's a grand number. It's very large. But also with that, if you look at the wage number, you see the huge jump in that as well. So I mentioned a lot of what the Fed did. What the government did is really on this slide. They said, all right, a lot of people are losing their job. We're going to have this CARES Act for companies to continue to pay people. We're going to replace that in the company's coffers. And also we're going to have unemployment to pay everyone. And we're going to have a kicker item on that too, that's $600. To the point where at one point the Fed chairman came out and said, I think 40% of all the people making $40,000 and under are going to be out of work. Dramatic amount. With the way that they crafted this CARES Act and the unemployment structure and unemployment benefits, they actually are making more money than they were prior, that group right there. And it kind of set up to almost be $60,000 a year. So there's people making more right now. Certainly at the time, it was great because everything was set. People still had money, and the economy didn't crater like people feared. I will say on a short-term basis, it's getting to be a little bit more of an issue because the auto companies are trying to gear back up and build automobiles, and not all the people want to come right back to work because they're making so much on unemployment right now. So we have to iron these things out. They did an altruistic measure that right now is going to the end of July, and we'll see what the next package brings. So when you look at the markets, yes, they're high. Are they inflated? Well, because of the $7 trillion of the capital that the government has infused into the system, it's being supported by that. So one of two things is going to happen. We have to either turn on the economy and we can start using our own funds and earning our own wages, or the government would have to create the next package. So that's what kind of that's what you'll start seeing. That will create volatility. So volatility is probably here to, I shouldn't say probably, it's here to stay for a while. And it's going to have that whole balance right there. Go to the next page. So as we look at municipalities, there's a lot of economic slides we can put on. I used this before, so I will kind of use it again because I think it's important. If you look at, these are kind of the social distance vulnerability is the name of the slide. It's essentially looking at different sectors that are really impacted by the COVID-19. On top of that, these are also ones that impact your taxes that you'll be getting in from different sectors. So on that top one, you see that it's retail, ex food and beverage, because it's not the grocery stores, restaurants, entertainment, transportation, hotels. So if you think of those, it might ring a bell. Okay, hey, we just tied our OPEB money to the restaurant tax or the hotel tax. Or we get we're a vacation kind of town, and we're expecting a lot of those. So we can see how that's impactful. And the way this draws to completion, how maybe more impactful maybe to municipalities and say the S&P 500 overall, is all those sectors I just talked about. I think they're very impactful to you guys municipalities. They're, I think you can see they're 19% of the GDP or essentially the revenue. They're 20% of the employment. So that's a lot of people putting to work. We need to get back to work and get moving. But they're also just 7% of the operating on that right-hand side, the operating earnings of the full S&P. So the other sectors actually make more of the earnings, but it's still a lot of people. So the S&P can still be doing a lot better because it's not as impactful to the operating earnings, but it's still going to impact you as municipalities getting your tax dollars from those entities and those people. So certainly an important part. So when we look at these are things that, and I said before, Margie said, as a director of fixed income, I'm looking at you guys bringing deals. I will say the municipal market, all that dislocation is gone. The municipal deals, though they trade on a relative basis to treasuries high, their interest rates on municipalities, or what you're getting when you're coming with deals, is quite low now. So I would actually call them expensive deals, but we're buying the paper for our investors. And we're talking Moody's for the same reason. Parker brought up an important point. When you go back to look at your funding plan, you have to say, all right, if it's scratched for a year, we've said all along, and we've said it to any time I think I've ever spoke, when you have a written funding plan, which is what they're saying, we need certainly with the Modernization Act, it's they'll forgive any kind of downside in economy, and a down economy for doing it, or I should say, scrapping it for a year, scrapping the plan as Parker kind of put out to the group. That would cause a lot of consternation and certainly potentially action from the rating agencies when they look at you long term for both your pension and liabilities and your OPEB. So the key is everyone involved here realizes the strain we're under, and they realize, I believe that, and I certainly have been looking, we as Rockland Trust have certainly been looking at it that way, that next year could be more difficult than this year. When you're with your budgets, but certainly putting those all together, they realize it now. As long as you keep your plans in place, show them how you're being creative or innovative to try to meet all these obstacles, and I think things will be fine on their side. And I am a little bit optimistic after seeing 2008 and coming out of that, and by 9 to 11, the coffers of states being increased fairly quickly because of the revenue generated by different states from different components of the economy. So I like that the corporate sector usually gets hit a little different times than the municipal. So I think that will shake out, it will continue to shake out this time as well. So if we go to the last couple slides here. So here, and I know we're speaking OPEB, but I want to still encapsulate, as I said, we're worried about all your funds, because if you don't have the funds on the top part of that, or the more conservative ones, if you don't have general funds or or free cash, free cash, then your general funds and your all things that allow you to operate, and you don't have rainy day or stabilization funds, it's very difficult to say, hey, we're going to put more to OPEB in the other way around. So we want to make sure we always are watching all those different buckets. So you can see the allocation that we say in general on the right-hand side. You want to be conservative with your more your cash with the lower in here, and I'll go back to that too. Always hear me say it's managing money as you invest to your time horizon. If you tell me when you're going to use your funds, I can tell you the asset allocation that makes sense really along the lines anywhere. So you can see the more conservative ones should be certainly more fixed income. As you get longer dated, they're more equity. OPEB we have at the bottom here, and we say, well, it should be very much equity laden portfolio. Two items, and I think they're very important ones, but the two ones that essentially caveats to this is one is your funding policy. If you don't have your funding policy, I'll use the term ironclad, or ironclad, or have buy-in across city or town hall or across the municipality, then it doesn't make sense to be too aggressive if people will question returns on your assets. So if they give you that $1 million, and you've seen it, like the hands almost shaking like this when they go to hand you that first check, or depend on how many checks are in still. And if you're going to be scrutinized heavily by what the market does, which that's easy to happen right now, or 08, et cetera, it's difficult to be aggressive with that, because then if that $1 million is 850 or 800,000 on June 30th, they may never give you the next funding, or be very difficult to get that. We don't want that to happen to you. So in that case, being a little less aggressive, riding the market through, making more or multiple contributions, getting that inertia around the program, buy-in from all the different offices or everyone that you work with there. Then when everyone signs off on it, then you want to get more aggressive. The second one is if you're already highly funded, a lot of municipalities or ones that have revenues attached to them, lighting plants, et cetera, have the revenue source that's easier to fund. If you start your plan with a higher funding, and so you start with a lower allocation, it can be built into your discount rate, and then since it's already known, you can remain more conservative. It's not as easy just to say, oh, I was very aggressive. I've made, now I'm highly funded, and so I'm going to get more conservative, because Paco will tell you, well, then if you change your allocation, then I got to change the discount rate, and it'll take you back some. So it's got to be conversations along the way. So those two key caveats, and I spent a little time on them, but I think they're important, because other than that, if you see these amounts of stock to bond, and it's really the far left side, if you just look at those symbols, and we go to the next page, you can see what happens here. So if you take $1 million, and I did it for simplistic sake, oh man, easy for me to say today, sorry, for simplicity, we took $1 million and we can essentially merge it with a bond stock portfolio. So we're going to be more diversified with OPEB, but this is pretty straightforward. Intermediate bonds in the S&P. And if you had that for 30 years, you can see the returns from essentially 12/31/89 through 12/31/19. So you have 30 years, and that's the return that you would be investing at those similar allocations. You can see what your $1 million turned into. So if you have general funds, you've made good money on it, but obviously those will be moving around as you go. But you made good money, but you're still, it's good for just spending on the next capital project, et cetera. The problem you have when you start talking about OPEB is if you have $1 million, you get most aggressive. Yes, you can have $12.5 million, but most of these people that are putting $1 million in the beginning may have $30 million or $20 million they're going to reach to, or heck, even if it's 15. You can't do this OPEB plan with just investments or just financing. You're just asking too much from the taxpayers on one side, you're asking too much from the market on the other. You need those to mesh or to marry, if you will. And so if you look at that, going right down the page, if you have the more aggressive you are invested, the more turbulent they're going to be. You're going to feel this volatility a lot more every time it rears its head. But you're going to get to a spot in the long term that's going to be better, or just look from a balanced portfolio, which is that green triangle, to the olive, or the lighter green, which is what we call kind of a growth of 75-25 stock to bond. You can see just that differential, or almost a full percent, is almost $3 million. Or, if you get almost $2.8 million. If you're going to get that difference, you're either going to get it from the returns, or you have to go back to your populace and say, hey, we're going to have to raise more funds. So if you can do it both ways, and remember this, if you're adding $1 million a year, or even a couple 100,000 into this, the numbers on the far right side go up dramatically because you're getting return on top of current contribution. So I didn't get that deep into it for this one, but it's really straightforward. You're going to need both. So if you're invested in the stock portfolio, that fourth point I kind of said, what should I be doing? You want to be in that portfolio. And we threw up 30 years. That's actually short almost for OPEB, because it's almost a 30-year funding, and then people are still going to be retired for potentially several decades after. So it's a very long time period. 30 years is not, we're not stretching it here by any shape. So you want to be invested that long, and you're not going to be taking the money in and out. So it does make sense, but you want to make sure that your funding plan is rock solid, so that they won't have second thoughts on your funding plan in normal times. Well, I spoke for a while there, but I want to get all those points across. So that was important given the time frame and the tick up in volatility. I will turn it back to Parker to sum us up and beg for all questions and comments that you can have.
Well, thank you, Brian. I really much appreciate it. And Margie and Rebecca, I appreciate all you guys have done here. Definitely appreciate you guys sharing your insights and your time. It definitely is very welcome. I definitely appreciate it. I'm getting a couple questions in the chat box. One was asking about mortality in terms of, hey, is this going to, COVID-19, is that going to cause mortality table issues? The short run, the answer is no. And I'm going to just quickly, here it is. I'll stop sharing the screens here. That way you guys can see all our lovely panelists in all their glory. And so no, I mean, so the thing here is, so the mortality tables, here's the thing. If you tell me that COVID-19 is an every year situation, then yes, it will have an impact. But as of right now, honestly, the opioid crisis is a far bigger impact as it relates to mortality tables than is COVID-19, because that really deals with years of life lost. In COVID, obviously, if you're the impacted party, you don't see it this way, but it's primarily hitting much older people than it is younger people, whereas the opioid takes out a lot of the middle age, for lack of a better word. So there's a much bigger impact in terms of mortality table. Another question was really about, let's go back and get the question. It was about the muni bond rate. And Brian, I guess if you can talk about this a little bit. The question was really, with everything the Fed is doing, trying to drive rates down to zero, what's that going to do to our discount rates? Obviously, the muni bonds have been fairly stable for the most part, but it's obviously going to have a negative impact, or I would assume it's going to have a negative impact on long-term bond portfolios, as those have been driven 10-year treasury down to, I think, 0.75 or thereabouts. So you want to talk a little bit about what the Fed's doing and how it's going to impact the bond portion of your portfolio?
Yeah, so not only did the Fed, take short-term rates to zero, 10-year to, as Parker just said, 73.5 basis points right now, and yep, over it is. And so, and not only that, they came out last week and he said they essentially expect to be at this interest rate level for the next 2 years. So they're not going to, I don't expect them to move rates dramatically in the next time period, for the foreseeable future, really. And I think that would only be a portion of it anyway. As they're pumping $7 trillion into the system to save it all now, it's one of those. Don't ask for the present you have when you get it, but in the future, everyone's going to be asking questions. I mean, just like last time in 2008, everyone was really happy the government saved the day with quantitative easing. Then they just attacked the Fed's balance sheet. So they'll do similar to this in the future. How they'll unwind it, we can only speculate at this point, but certainly it's going to have an impact on rates. The longer it's in the system, the lower and longer rates will stay that way. And then what we'll wrestle with is, it does, and we saw this when we were coming out of it, coming out of 2008. It's not the movements the Fed makes putting money back into the system almost move rates more than when they actually make a Fed discount rate movement, the FOMC, because there's so much, it's essentially it's a buyer and seller market, right? So right now when they're saying, hey, we're a buyer, they're just sopping up any liquidity out there, or creating liquidity because they're buying everything. The opposite, when they're a seller, there has to be people on the other side purchasing it, and if they're not there, rates could shoot up quite quickly. So, but I just made a long answer of it. The short and narrow is, if the Fed says they're not going to move for 2 years, and we have just put that much in the system, not much currency or capital in the system, I think it'll take a little while before we see rates even think about normalizing.
Well, thank you, Brian. I very much appreciate that. And so, everyone, I know we're pretty much up at the hour, so if anybody has to leave, I certainly understand. I do appreciate everybody participating in the polling. Just a quick aside, seems like a lot of people wanted to hear about pensions, OPEB, and the rating agencies, and we're going to be doing a session with the folks in Bartholomew as well as Standard & Poor's. It looks to be in August. I'll get you more information about that as that comes available. So we'll definitely get you some information on that as we get closer, and we'll look at some of these other things and see if I can get you experts on any of these topics that people seem to care about. That's the key thing I try and tell you folks. I mean, listen, we very much appreciate the opportunity to serve you folks. It's a great pleasure for myself and my team. And if there's things that we can do, again, we don't have to have all the answers. I'm happy to bring on the experts like Brian and Margie and Rebecca and their team, or anybody else I can get. So if you guys have things you want to hear about, let me know, and I'll do my best to get the experts and bring them to you guys. So again, I appreciate everybody's time. I know everybody's busy. It's a beautiful day, and you came to talk OPEB. Much better souls than most people. I give you credit for that. And very much appreciate everybody's time and effort. And again, thank you all for your time. And if I can do anything, just reach out to myself or any of the Rockland team, and we will get you whatever we can. And this recording should be available within probably 48 hours. And if you need more, just let us know. Thank you again, folks.
Yeah. Thank you, everybody. And all questions are welcome if you want to reach around on the side to any of us, or they were on the slide. Same thing, rating agencies. We're buying municipal debt all morning. So I see the other side and the rating agencies on all day long. So any questions you have, I'm more than happy to address them.
Thank you all.
Thank you.
Thank you. Thank you, Park, for having it. And thank you, everyone, for attending.